Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Frederick, Managing Director of Trading Derivatives at the Schwab Center for Financial Research, to discuss the latest CPI data, its potential impact on the Fed rate hike policy. We'll also take a look at market breadth participation and discuss triple witching taking place this week as well. And Randy, there's a lot on the calendar this week, right? In addition to other economic data that's coming out, the market seems to be taking it in stride, especially after the CPI data that we received.
For sure. Last week, we had almost no economic data, and the market was kind of a snooze fest all week, but yet surprisingly so far. I mean, granted, it's early in the week, but we've got CPI today, as you know, and then tomorrow we got the PPI, and then we got the Fed announcement, which this time I think there's a very high probability that we'll not see a rate hike. That seems to be what the futures markets are telling us, less than a 10% probability. Historically, going back through the last 8 years, it has been at least a 65% probability before we got a rate hike. With only a 10% chance, I'd say it's not likely going to happen.
Right. And then by judging in the market action that we've seen this week, it seems as if perhaps we might get a hike in July. But one CPI print, that data point is not a trend make. I don't think that the Fed might necessarily show a major reversal of its strategy as it relates to interest rate policy. Certainly pausing, but not cutting.
Yeah, and I think that's why they're kind of calling this a skip as opposed to a pause. So the pause kind of implies that they're not going to hike any longer. Skip implies that we're not hiking now, but we intend to hike in July. And the probability of that is about 60% right now. So granted, those change every day. So it certainly could go up and could go down, and it probably will over the next 5 weeks. But that is a high enough probability. There's still a good chance of that. And obviously, there'll be some more data points. We'll get another CPI print. We'll get a PCE print. We'll get more labor market reports, all those sorts of things. But at the moment, because the CPI came in pretty much as expected, the core was a little 1/10 above expectations. The headline was 1/10 below, averages out to about pretty much what was expected. But if you look at the trend, yes, prices are still going higher as they have been for a very long time. But if you look at the rate at which they're going higher, that rate's actually declined now for 11 consecutive months. So going all the way back to June of last year, each month, the amount that prices have gone up has been at a smaller increment. So they're definitely heading in the right direction. But at these current levels, certainly they're nowhere close to the Fed's 2% target. 2%, of course, is an ideal target. I like to sort of use the analogy. This is kind of like a speed limit. Whatever the speed limit is, that's on a sunny day when it's dry out. That's not nighttime. That's not when the roads are slick. And this is kind of the same thing. 2% is the ideal target that they would love to get to. But I think in reality, though they don't say this publicly, they'd probably be happy to have inflation somewhere between 2 to 3.5%. So I think they're just trying to manage downward. And if we see 2%, frankly, it's probably going to be sometime towards the end of 2024 before we actually see those kinds of numbers.
Let's talk about market breadth for a moment here, because the other narrative has been there's a group of, let's call it 7 to 11 stocks that have been moving not only the Nasdaq 100, but the S&P 500 as well, due to the technology weighting there. Are you seeing any improvement in participation?
Yeah, you're right. And the Nasdaq 100 has been knocking it out the ballpark. And it's mostly because of those big names, Apple, Microsoft, Amazon, that make up a very big portion of that index. And in fact, if you look at it from a sector standpoint, virtually all of the really spectacular performance this year has come from the information technology, the consumer discretionary, and the communication services sectors. Those three sectors are outperforming the rest of the market by a huge amount. And so the breadth, while it does look like it's starting to show a little bit of improvement, it's really not been very wide. And in fact, really just since about the beginning of June, which is only a couple of weeks now, that it's actually been showing some improvement. But honestly, there's still a wide gap there. Now, people will say, well, that's terrible, and that means that the trend is not sustainable. What I always tell people is, you know what, though? Most likely, you own some of those stocks. You either own them directly, or if you own any broad market or even sector ETFs or mutual funds, you probably own some of those stocks anyway. So not to say that there's nothing, there's not anything to be concerned about, but certainly these big names are the names everybody knows. And so, yes, while we would love to see broader participation, and we've seen a pickup in the Russell lately, so that some of the smaller companies are coming online, mostly that has happened just since the debt ceiling issue was resolved.
Right, Randy, let's switch gears and talk about market mechanics for a moment here. We have triple witch options expiration on Friday, and the markets are also closed on Monday in observance of Juneteenth. Is there any impact to the options market?
Yeah, so this Juneteenth holiday, as you know, is relatively new. It's only been around for a few years. Triple witch expiration, as you know, is not. It's been around for a very, very long time. Nowadays, we have expirations every week. We even have some big names that have expirations every day. So what used to be a huge deal, the third Friday of every month back in the old days, was the only time of the month that we had expiration. It was a big day, without a doubt. That day has continued to get watered down more and more and more and more. That said, the quarter end expirations, like the one that we have coming up, the triple witch, quadruple witch, whatever you care to call it, is still a pretty big one. If we look back over the last several, so that would be the one we had in March, and then we go back to December, September, and June of last year. What I was taking a look at these. What I found was that on average, the market was down about 1% on each of those days. Now, that's not great, but I will say that that wasn't like the start of any kind of a trend. And in fact, within the next couple of days, the market had recovered that loss in almost every case. But what we do see, and this is consistent, is volume. Volume's always heavy. Heavier than normal volume on those days. And any monthly expiration typically has higher volume, but the quadruple witching ones, the quarter end expirations tend to have even bigger volumes. So the big caution for people, and I oftentimes will send this out over Twitter, is that don't wait till the last 5 minutes of the day to close out a position. If you've got one, do it in the last half an hour so that the market has time to work through it. But other than that, it's not anything to be too terribly worried about. And we can all just be happy that we got a long weekend to look forward to.
Yes, we can. All right, Randy, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
You're welcome.